Hey guys, we're going to learn how to calculate interest today, how to make the journal entries for when a company loans or borrows money, and what to do when the company either receives that loan back or has to pay that loan back, depending on which side they're on. So first of all, you need to know a few terms. You need to know what a principal amount of the loan means. And the principal amount just means the original amount loaned or borrowed, again, depending on which side you are of it. So you also need to know what interest is. Interest is the cost of borrowing money. So when a customer goes to pay money back on a loan, or even an individual, say you borrow money from the bank for your car or for a remodel project for your house, you not only have to pay the principal amount back, but you also have to pay interest back. That's the cost of using that money. And every day that loan is outstanding, interest is rolling or getting incurred. Whether it's, again, with a credit card, you borrowed money from a bank, however you borrowed it, unless it's maybe from your mom and she's not charging you interest. So you know principal and interest. So I've got a problem here on the board with two different years, 2021 and 2022. And I say we're always looking at this from the company's point of view, okay? So the company loans $10,000 to someone, could be a customer, could be an employee, could be a vendor of theirs. They loan $10,000 for 6 months at 12% with the principal and interest due at the end of the loan. So whether the problem tells you or not, this is a really key piece to getting this right. The rate always represents an annual rate, always. And what that means is that this company is going to charge 12% of $10,000 for every year, for every 12 months that the loan is outstanding. So even if the customer only borrowed the money for 6 months or 3 months or 1 month, the rate is always presented as an annual rate. And you have to go and figure out how to prorate that for just 1 month or 3 months or however long it was outstanding. So suppose in this one that we loaned the money on March 1st, we being the company. So we loan the money right here on March 1st. When is the customer going to pay that money back? Well, remember, they're going to pay back the principal and the interest at the end of the 6 months. So that loan is going to be outstanding for March, April, May, June, July, and August. There's our 6 months. The customer is going to need to pay the money back on August 31st or September 1st, however you want to look at that, 6 months with the interest. Okay, how much interest is it? So we come over here and we say, well, the principal amount was $10,000. If the rate is 12%, we multiply that by 0.12. That's how we turn a percent into a decimal, right? And 10,000 times 12% would be $1,200. Stop right here and make yourself a note. If students make a mistake, here's where they make it. If I ask, what is the interest cost of this loan? Again, if someone makes a mistake, the most common mistake is here. They tell me $1,200. But remember what that $1,200 represents. An annual amount. That would be only if the loan were outstanding for 12 whole months. It's only been 6 months, right? So how much is it? Well, this one's pretty easy to see and do in your head. If 12 months was $1,200, 6 months would be $600, right? But I'm going to carry it out a step further because it's not always so easy. I'm using easy numbers so that I can do it in my head on the board here. So if we say 1,200, here's what, if I were you, I would write on my test or on my problem because it's going to keep you from making a common mistake. 1,200 is for 12 months. So if we divide that by 12 months, then that is $100 per month. I'm going to write this on the timeline because it's going to help you see something a little more complicated that we do in a minute. So for every month that this loan is outstanding, the company is earning $100 in interest. And so you can add that up, 1, 2, 3, 4, 5, 6. And we can also say, well, $100 a month times the loan was outstanding for 6 months would be $600. So if the company's the one loaning money, The company is earning interest. It's not a cost to them, right? This is revenue to them. So that would be similar to a bank. That's how banks earn their money. They loan money out to customers. Customers pay them back with interest. So what are the two journal entries that need to be made? This company needs to make a journal entry on March 1st when it first makes the loan. So I'm going to come over here on March 1st, get my blue pen. On March 1st, the company would make a journal entry of a debit of notes receivable, not payable. The company's going to be receiving this later, so that's an asset of $10,000. And then they would have a credit to cash of $10,000 because their cash went down. They gave the customer money. Not gave it, they handed it to them to loan to them, right? So that's the entry the company makes on March 1st. What entry does the company make on August 31st or September 1st? So in this class, we're not going to be nitpicky and go by days. I'm always going to give you 3 months, 6 months, 18 months. It'll always just be a round monthly figure. We're just learning how to do this. So we'll say on September 1st, when the customer goes to pay us, the company, money back, sometimes I say if you can't think of account names, ask yourself from the company's point of view, what did we give? What did we get? So think of the company on September 1st. What did they get? Well, hopefully they got some cash, right? Picture that customer walking back in their door and paying back the cash that they owe. So now our debit is going to be to cash because that's how we increase cash. Think of how much. How much does that customer owe us, the company, now? They owe not only the $10,000 that they borrowed from us, but also the $600 in interest, right? So my cash is going to go up with a debit of $10,600. Now, what's my credit to? My credit, for one, is going to be to an account called Notes Receivable. Because remember, initially, we recorded an increase in the asset of Notes Receivable by $10,000. If the customer's now paying us off, that notes receivable needs to go back down by just $10,000. So my credit right here is going to be $10,000. So let's stop and look at that. We know that's not a complete journal entry. Why? Because my debits do not equal my credits, and they always have to equal. Debits have to equal credits. The other reason is that, again, like I said, your notes receivable is just going to go down by the amount that we put in there. So what am I going to do about this? How am I going to make my debits equal my credits? I know that I need a $600 credit over here for the right side to equal the left side. What could that $600 be? So ask yourself, what does that $600 represent to the company? That represents interest they earned by loaning out money, right? So when a company earns something, what do we call that type of account? Hopefully you said a revenue account. So we're going to call it interest revenue. The way we increase revenues is with a credit entry or on the right side. So I'll abbreviate here because I'm running out of room, but that's my final journal entry there. We got some cash, we earned some revenue, and we reduced our notes receivable there. Okay, stop the video if you need to kind of work through that and make sure that makes sense in your head because that's the easier piece to this. We're going to work the same exact problem, but we are going to start the loan on a different day, which is going to make it cross over into the next year, and it's going to make our journal entries a little more confusing. So let me stop and remind you that the income statement, revenues minus expenses equals net income, is covering the income and or the revenues and expenses over a period of time. In this class, we generally look at it 1 year at a time. We want to close out these accounts at the end of the year so that we can start over next year with zero balances. And what does that do for us? It allows us to compare income statements from 2021 and 2022 and see how we did. Did we do better? Did we do worse? You can look at it a year at a time. Well, in this scenario, the money was loaned in 2021 and it was paid back in 2021. So all $600 of interest were earned in 2021. It's all $600 is going to show up under the 2021 income statement in revenue, okay? Easy peasy. So now let me erase my journal entries over here. And I'm going to erase this up here. And again, I said the problem's the same. The company still is going to loan $10,000, same rate, still for 6 months. But this time, they're going to loan it on November 1st, right here. So we do the problem, we start the problem the same way. $10,000 times 12% interest is $1,200 if the loan is outstanding for 12 full months. So no matter how long it's outstanding, I always stop right there and go, well, how much is that a month? Well, $1,200 for 12 months divided by 12 months in the year would be $100 per month. But what do we know happens when we get to the end of December or a reporting period? In this class, I always make it December 31st. We know that a company has to stop and create financial statements, a balance sheet and an income statement, right? And again, on this income statement, we're only reporting revenues that were earned in 2021. So see if you can look at the 2021 timeline here and tell me how much interest revenue the company has earned just in 2021 now. If it's $100 a month, the company earned $100 in November and $100 in December. Are they going to keep earning? Yeah, as long as the loan is still outstanding, which it will be. They've got 4 more months of it. But for just 2021, now the company's only earned $200 in revenue, right? So let's stop and make some journal entries. This is going to take you back to chapter 3, where you learned about adjusting journal entries. So if you need to go back and refresh on that first, do so. But on November 1st, so I'll say 11/1 over here, our first journal entry is just from the company's point of view. What did we get? What did we give? Well, we gave cash. We loaned cash to someone. And in place, we got a note from that person promising to pay us back. We're going to receive the money later. So our note receivable is our debit. That's how we increase an asset. And cash is our credit. That's how we decrease an asset. This is really helpful if you compare this side by side with the example I did earlier. Notice that this first entry, exact same. What changes is when the loan is outstanding over 2 different years rather than in 1 year, you earn the revenue in 2 different years. So we've got to stop and make one of those AJEs, adjusting journal entries. And that's what I'm going to do right here on December 31st. So what you have to ask, again, from the company's point of view, how much revenue have they earned? Well, 2 months worth. Be careful here. I say this in class a lot. Don't let your brain say 12 for December minus 11 for November is 1 and trick yourself and go, oh, they've only earned 1 month. Because see, it went from 11/1 to 12/31. It was all of November and all of December. Count on your fingers if you need to. That's what I do. So even though the company isn't getting paid anything yet, because the problem said the principal and the interest aren't due till the end of the loan, the company still has to stop and make an AJE to accurately reflect their accounts on their financial statements before they present them. And so you say, well, did the company earn anything even if the customer hasn't paid them any cash? Yeah, if you do the work, provide the services, provide the goods, you've earned it. And in this case, yes, the bank earned it, or whoever the company is, because they really did loan the money. So what's our debit and what's our credit going to be? Well, from the company's point of view, they've earned revenue. How does revenue go up? With a credit entry. It's on the right side. So what is their debit? What did the company get? They didn't get cash. Be careful. Not going to get cash till the end of the loan. So they get another receivable. Instead of calling it a note receivable, we're going to call it interest receivable. So my debit is going to be to interest receivable, still an asset, so that's why I'm debiting it, for just $200. That's all the customer owes at this point. They're not paying it, they only owe for the 2 months worth. And then my credit is going to be to interest revenue 200. Again, only reporting what we've earned this year. So we're updating our financial statements to represent that. So now for this one, the 2021 income statement is only going to show 200 in interest revenue. So then what happens next year when we roll around? Well, the customer comes in and pays off the loan on March 1st. So the loan has been outstanding another 4 months. How much interest was earned during that time? Well, if it's $100 a month, $400, right? 100 in January, 100 in February, 100 in March, 100 in April. So March 1st, the customer walks back in and pays off the loan. What does the company need to record? What did they get? What did they give? What did they get? Well, now they got some cash. So before you watch this, see if you can write this down and answer. How much cash did the company get? How much cash did the customer have to bring the company? They had to return the $10,000, and how much in interest? I hope you didn't say 400. That's how much the company earned this year. But the customer, remember, they haven't made a payment at all. They still owe all the interest. They owe the cash from the interest last year and this year. So the customer owes the full 600. So the cash that the company receives is $10,600, just like the cash received on the problem we did before. What changes is when it was earned, and because it crosses over 2 years, that's what makes this problem different. Okay, cash is $10,600. My credit's going to be to notes receivable, again, just for the $10,000. So notes receivable, credit for $10,000 to make that go down. Now what about the rest? Well, also for the interest receivable, that goes down now too. The customer just paid it off, so I'm going to say I/R, interest receivable, $200. Can I stop there? Do my debits equal my credits? And they do not. What am I missing? See if you can figure out what I'm missing in that journal entry. So what I'm missing is the revenue that the company has earned this year, 2022. So interest, sorry, I'm getting really low to the bottom there, revenue of $400. And again, that represents 2022. So now I don't have room, but for my 2022 income statement for the company, it would show revenues of $400. And again, that's why we have to stop and make this adjusting journal entry. We didn't have to do it in the first problem because the money was loaned and paid back all within the same year. And so from the company's point of view, the interest was earned all in the same year. So draw yourself timelines if that helps you, because usually the adjusting entry piece is the hardest piece for students. So let's flip this over and look at it from what if the company borrowed money. Do companies ever borrow money? Yeah, all the time. So see if you can write down the journal entries that it would be. The same thing would be happening, except for instead of the company earning revenue, they would have an interest expense. That would be a cost to the company of borrowing money. And the company would have a note payable, a liability, instead of a note receivable, an asset, right? So like here on the first entry, the company would receive cash if they're borrowing money, and they would have a liability in the credit section called a note payable. And then for the adjusting journal entry at the year end, the company would have interest expense. Even though they hadn't paid any cash, they still incurred 2 months of an expense, and they would have another liability called interest payable. And then on March 1st, the company would pay back cash, so that would be our credit, and our debits would be to some interest expense, to the interest payable to wipe that out, and the note payable to wipe that out. So just be really careful in this class. We're always looking at everything from the company's point of view, not the customer's point of view, not the owner, stockholders' equity point of view, always from the company's point of view. And just ask yourself, wait, is the company borrowing or are they the ones loaning? So same scenario, you're walking through the same steps, but if the company's the one borrowing the money, they have interest expense and a liability to pay that money back. If the company is the one loaning out the money, then they're earning interest revenue, and they would have a receivable, an asset, until the customer pays them back.